Gold and silver are such thinly traded markets. Gold, there's quite a bit of gold in the world, but most of it isn't for sale. So the available gold is an extremely thinly traded market. And so you could see a lot of people trying to get in through that little door, and push the price of gold way up. So to do a new gold standard in which, for instance, the outstanding dollars are backed 40% by gold, a lot of people who've run those numbers get a price of $10,000 US an ounce for gold to make that kind of a gold standard happen. So if that's our end game, and $10,000 an ounce is the end price for gold in that process, then all of a sudden $2,700 an ounce doesn't look crazy expensive.
In a landscape of monetary uncertainty, gold continues to assert its role as a cornerstone of financial stability. Currently trading around $2,655, the precious metal has shown resilience despite recent market fluctuations. This is supported by modest downward movements in US Treasury bond yields that have kept dollar strength in check. Financial analyst John Rubino discusses the potential for a new monetary system where the US dollar is partially backed by gold, possibly driving prices to $10,000 per ounce. While this target is ambitious, it highlights significant upside potential, with current prices around $2,700, offering potential gains for investors who bought even at $3,000. Central banks have emerged as pivotal players in the gold market, demonstrating unprecedented buying activity. The statistics are striking. 1,082 tons were purchased in 2022, followed by 1,037 tons in 2023. This institutional commitment to gold appears poised to continue, with a mid-2023 survey indicating that 24% of central banks intended to expand their gold reserves within the following year. The mechanics of the gold market add another dimension to this narrative. Rubino emphasizes that the demand for available gold is relatively thin, meaning that concentrated buying pressure could lead to outsized price movements. This dynamic becomes particularly relevant when considering the sustained interest from central banks and financial institutions. While the $10,000 price target might seem extraordinary, market observers consider a more moderate projection of $5,000 by 2030 increasingly plausible, particularly when factoring in ongoing inflation trends. Despite recent price rallies potentially affecting trade execution, central banks are expected to maintain their position as net buyers, providing consistent support for gold valuations in the coming quarters. Before we begin this video, please remember to subscribe to our channel and hit the bell icon so you never miss an update.
Gold, which tends to go up in during chaotic times, and war is the ultimate in chaotic times, all of a sudden people were like, oh, World War III might not happen after all. Well, I can sell my war hedges, and gold is one of them. So they went risk on for tech and Bitcoin, and risk off for safety assets like gold. So that makes complete sense. Then, after the dust settles a little bit, everybody starts realizing that the stuff we talked about today is actually true, that, okay, maybe we won't have World War III, but we're still, borrowing this much money. Interest costs are still doing this. Trump wants lower interest rates because he's a real estate guy. His formative experience with interest rates is that low is good, high is bad. And he's going to insist that the Fed start cutting interest rates. Well, that's good for gold. Okay, so people have been piling back into precious metals over the last week. Because they assume that, the finance thing is going to be hard to fix. And the guys in charge are not equipped temperamentally to raise interest rates high enough to protect the value of the dollar and to throttle inflation. That's not going to happen. So we probably want to own inflation hedges. And there's really no end to that now. If people develop that kind of an attitude, and then you've got foreign central banks buying gold, which puts a big tailwind behind gold, and then regular investors and the rest of the financial markets in the US decide that inflation hedges are a pretty good thing to put their clients into. Gold and silver are such thinly traded markets. Gold, there's quite a bit of gold in the world, but most of it isn't for sale. So the available gold is an extremely thinly traded market. And so you could see a lot of people trying to get in through that little door, and push the price of gold way up. So to do a new gold standard in which, for instance, the outstanding dollars are backed 40% by gold, a lot of people who've run those numbers get a price of $10,000 US an ounce for gold to make that kind of a gold standard happen. So if that's our end game, and $10,000 an ounce is the end price for gold in that process, then all of a sudden $2,700 an ounce doesn't look crazy expensive. It feels like a good price considering where we've been. But if you look at where we're going, people who bought at $3,000 an ounce are going to be very happy when gold is $10,000 an ounce. So, that's the gold story in a nutshell. And it's very positive with some squiggles. There could be a recession that smashes gold down for a few months, but then the follow-on to that will be aggressive Fed easing, which will send gold back up towards 10,000. So, if your only risk is a short-term V-bottom correction and your ultimate price, which is very easy to justify, is 3 or 4 times today's price, then it's easy to see how people can justify adding gold at today's prices.
John Rubino presents a nuanced perspective on precious metals behavior during market downturns. The 2008 financial crisis offers a particularly instructive example of gold's complex market behavior. Though gold demonstrated impressive strength over the entire crisis period, nearly doubling from $825 to $1,650 per ounce across 5 years, the journey wasn't uniformly upward. The crisis, which stemmed from a perfect storm of factors, including a housing bubble, risky mortgage lending practices, complex financial derivatives, and regulatory shortcomings, created unprecedented market turbulence. The same crisis period revealed a stark contrast in the performance of different precious metals. While gold ultimately thrived as investors, businesses, banks, and the public sought its perceived safety, silver experienced a dramatic 58% decline in October 2008. This divergence highlights how different precious metals can respond differently to market stress, with silver behaving more like an industrial commodity during the credit crunch. The recent COVID-19 pandemic of 2020 and 2021 provides another critical case study. During this extreme economic and social disruption, gold demonstrated its safe haven appeal, surging 27% from $1,575 in January 2020 to over $2,000 by summer. Let's get back to the video.
There's a near-term bear case for gold. Look what gold and silver did in 2008 and in 2020 when we had really sharp stock market bear markets, really sharp corrections in stocks. Precious metals got sucked down with equities in both of those cases and went down, 30, 40% or more in the case of silver. And that's a very real, I would call that a probability rather than just a possibility. So that's kind of a bear case for precious metals. You can make the case that you at least want to buy very cautiously now and maybe even take some profits here in the expectation that you can get back in at that V bottom. Okay. The longer term bear case is less likely, but still possible. And that is that when we come to the crossroads of hyperinflating or going back to a 1930s style deflationary depression, we choose the 1930s, and decide, okay, we're just going to let this debt be wiped out via default. And in that way, we're going to, protect the integrity of the financial system and protect the value of the dollar. And then, once we hit bottom and we're no longer deeply indebted, then we'll do what we did in the 1950s and 40s. We'll grow because we have a relatively stable balance sheet. That's highly unlikely, but it's possible. But the reason it's unlikely is because that requires the people in charge to be this generation's Herbert Hoover. In other words, the guy that we still remember from 100 years ago who brought on the Great Depression. Nobody wants to do that. So it's much more expensive to mine gold and silver now than it was. And labor is harder to get. There's a whole generation of mining engineers who are retiring. So you got to pay up to get good talent now, too. So you combine, higher energy costs and higher labor costs and lower grades and deeper deposits. And you get much greater difficulty in profitably mining. And that's happening to a lot of the big miners where their revenues are going up because of higher gold prices. But the profitability that should have flowed from that higher revenue isn't really there yet. Profits are going up for some of the really well-run miners, but not spectacularly. And for some of the others, profits are up hardly at all. Cash flow isn't what it should be. And it's better. It's not going down or anything. It's just not like growth stock levels of positive earnings trends and cash flow trends. Now, having said all that, Q4 numbers for the miners ought to be good again. Q2 numbers were good, Q3 numbers were good because the price of gold was going up, and that was filtering to an extent down to the bottom line. So, the operating environment is better than it used to be for the miners. And there's going to be another quarter because the average price in this quarter has been higher than the average price in the third quarter. So the miners are going to report higher revenues again, and maybe this time it's enough to generate some really good cash flow numbers and get onto the screens of momentum investors. And that might do it. That might send a lot of outside capital into the mining industry, or at least start that trend. But understand that the higher the price of gold goes, the better the operating numbers will be for the miners. So I don't know when that is, but it could be that Q4 numbers are really good and the gold is still high, and that excites people about the industry.
Gold and silver have shown resilience in crises, acting as safe haven assets, but past downturns reveal their vulnerability to sharp declines during market corrections. While they often recover over time, short-term fluctuations remain risky, requiring investors to navigate potential losses amid economic uncertainty. What are your thoughts on the future of gold and silver? Share them in the comments below. If you found this video helpful, please like, subscribe, and hit the notification bell for more insights. Thanks for watching, and we'll see you in the next one.